Real estate investment practice problem used in Excel. Buy home versus rent calculation part number 3. Get ready because we're raising the stakes with real estate. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we have 3 tabs on down below. We got the example tab, the practice tab, the blank tab. Let's take a look at them now, starting with the example tab, in essence being an answer key. In prior presentations, we looked at the assumptions that we were making in order to construct our comparison of the home versus the purchase. Once we have that constructed, then you can go back in and run different scenarios, changing the assumptions. We then started to construct our data on the right-hand side, which we will go into more detail shortly. Note that the practice tab has pre-formatted worksheets, so you can work through the practice problem with doing a little less work on the formatting side of things. Then we're going to go to the blank tab, which is where we're constructing this thing basically from scratch. So we had our assumptions on the left-hand side. We calculated our payments, the amortization table. Then we made a pivot table for a year-by-year breakout based on the amortization table, which was month by month. We copied the pivot table so we have something easy to reference to. We then calculated the property value, assuming a 2% growth over a year if we were to purchase, concentrating on the purchasing side of things here. We looked at the cash flow before taxes on the purchase side. Then we looked at the tax calculation for the purchase side of things, calculating then the cash flow after we take into consider the tax benefits on the purchasing side. We then looked at the cash flow for renting, which we assumed just went up by 2%, straightforward calculation for renting. We would have just a cash outflow. And then we took the difference between the two, the renting minus the purchase gives us a net decrease if we compare onto the purchasing side of things, because we're looking at this from a capital investment in essence into the property for the purchase. So now that we have that cash flow going down, we got to think, well, what would happen then on the equity? Because the equity is going to, of course, be quite important when we're thinking about the purchasing side and the value going up, and then how we're going to realize that value, or when might we realize the value, what will be the tax implications and the costs related to doing so. So let's take a look and have another table here we're going to put on the left and think about what would happen with regards to the equity, and if we were to sell the property at any given time or at any of the intervals between 1 and 3 years. So let's go with the cash flow for sale before taxes, something like that. Let's wrap this thing up. I'm going to go up top and say this is going to be wrapped. Make it black and white again, black and white, center it. So we'll take this from 1 or 0, 1, 2. And copy this down again to our 30 years that we're talking about. And so then we're going to look at the sales price. Let's center that. So what we could sell the property for. So the sales price, assuming the property goes up that 2% each time, which we calculated already. So I'm going to go ahead and format paint this here. So we said the sales price was going to go up, and we already calculated this. This is right over here. That's like the first thing we did. We calculated this, so it's that 750, and then it's going up by 2% to the 765, and so on. So I'm just going to copy that cell and just copy this down. Right, just double clicking on it. There it is. So that's what we think the value of the property is going to go up. That's kind of our increase, in essence. Our equity is increasing in the property, but in order to get access to it, to actually spend it, we'd have to realize it, which means we would have to sell it. So then what would be the costs if we were to do so? What would be the costs on each point? We'd have to say, okay, well, what if I sold it in each one of these years? Selling costs then. Let's do the format painting here, format painter. It's going to cost us just to basically to the selling costs, which we're going to say is a percentage of the sales price that we'll have to take into consideration. So let's do that. This is going to be equal to the sales price times the selling cost. Now we obviously wouldn't sell it in year 0, but if we did, we're going to say that the selling costs we said were 7%, like the closing costs and so on, to sell the property. F4 on the keyboard, $ before the B and the 7. So it would cost us then 52.5. We're going to then copy that on down. We're assuming that's the cost that we would need to put in order to realize the property as a percentage of the sales price as it goes up. Then we also need to consider the loan balance that we would have to pay off, the cash flow going out for the loan balance that's still outstanding if we sold the property, getting the proceeds, paying off the sales costs, then paying off the mortgage on the loan on the home. Let's format paint this, clipboard, format painting it. So now we're going to say the loan balance is equal to, and we can pull that right from the information we took from like our pivot table copy. So we had our pivot table over here, and then we got our loan balances. So we calculated the ending balances at the end of the year. So I'm just going to say enter. So if we assume we sold this thing at the end of any one of these years, we've got our loan balances that we'd have to be paying off there. And then we got our net cash flow. So this would be net sale, let's say cash flow sales before taxes. Let's just copy this one over. And we're going to say it's going to be equal to the sales price minus the selling costs minus paying off the loan. So this is going to be equal to this minus, let's say, the sum of these two. Sales price minus the selling costs minus the loan we got to pay off. That's going to be our what we're going to get, copying that down. And we could think about that from each time period. If we sold it after 1 year, we could actually get an inflow after paying off the loan, and the selling cost, our idea would be 117, then it goes to 138, to 159, and so on and so forth. Now you also have a gain that could result in this, which could result in taxes. However, if it's your home, you will likely have an exemption that will kind of cancel that out up to 250 if not married, 500,000 generally if married. So we might want to consider the tax consequences here, of course, but we might not have any given the fact that if it's your home, you might have that huge exemption. But let's calculate the exemption, because if the gain gets substantial, then we can go over the exemption amount. So how can we put together the potential tax implications for the cash flow? So we're going to say, so cash flow sale for taxes, let's say taxes, and then let's center that. Let's do the same thing here. Let's go format painter here. So what's going to be the tax implications? 0, 1, 2, and see if we can break this out, copying this down to 30. We got to make these cells a little larger here. Make that one a little larger and this one a little larger. So here we got a little bit different than a little bit different calculation to calculate the taxes. We're going to start with the sales price, same starting point, which is going to be, let's go ahead and format paint the sales price. That's going to be equal to the 750. And then I'll just copy that all the way down. So that part is the same. But then we're looking at the selling costs. We're going to calculate that too, the selling costs. Picking that up, format painter. So we can copy that one right on over. Same thing on the selling costs. We could then kind of have a subtotal of the sales price minus the selling cost, sales net of the selling cost. So I'm going to call it a subtotal. And let's format paint that over. So that's the difference between, we're selling it for the 750 minus the 52.5, but we don't take into consideration the loan with regards to the tax implications. So what we're looking at is the comparison to the cost or adjusted basis. So now we're going to say that's kind of like the net sales price that we have. We're going to compare it then to the cost or basis. If there was some kind of added amount to the basis, let's go ahead and format paint that over. And that's simply going to be the 750 all the way down for us. We purchased it for the 750. I'll pull it all the way from our data to the left. Purchased it for 750. We're not going to say there's any improvements on it or anything like that. We're just going to say the cost is that original 750. That's what we bought it for. Going to say F4 on the keyboard, making it absolute, so we can copy that down. So that means that basically what we could sell it for is increasing net of the costs, because the sales costs could be part of something that we can call as part of the calculation for the gain or loss. And then we're going to say minus the cost. So the cost stays the same. What we sell it for hopefully goes up. So the difference then is going to be our gain or loss. So we're going to call this a gain, and the loss will be negative. I'm going to put in brackets loss, brackets. So the gain or loss then is going to be equal to what we have here, the subtotal minus that, which is in essence the net sales, minus the 750 cost basis. So we would have a loss if we sold it right away, of course, and then the loss here, and then of course we'd start to get a gain down as the value of the property increases. Let's make these a little bit larger. This one a little bit larger. Okay, so there's our gain or loss. Now, usually if it's our home, we get some huge exclusion, which is 250 to 500,000. So now let's say we have an exclusion. I'm going to use some fancy formatting just to practice using fancy formatting, which you don't need to do, but it can be useful if you're doing different scenarios. We're going to format paint here. And so meaning, obviously, you know, if it's a loss, we're not gonna have any tax implications here. So you could, like, if I was gonna manually do this, I'd say 0, 0, 0. I'm gonna have an exclusion. I'm gonna say up to 250, assuming we're not married, just to keep it at 250. Then we could say this would be the exclusion that would take care of that. Would be excluded down to about here. Now we've got, this is over the 250. So now we got this minus 250. That would be the amount that would be taxed because the exclusion is up to 250, we're going to assume. So the question then would be, well, is there a way I can do a formula to do that automatically so when I run different scenarios, it will populate that exclusion properly and automatically for us? So we could try to do a logic function, an if type of function. So let's see what that would look like. So we're going to say, all right, let's try this. We're going to say equals if brackets logic function. We want to say if this number is less than 0, let's say if it's less than 0, then comma, I want to take then the 0. So if it's less than 0, I'm going to take 0 on the exclusion. And if it's not, so comma, now I'm on if it's false, meaning if it's greater than 0, then I want to cap it at the 250. So now I've got two things that can happen. If it's greater than 0, I either take this number or I cap it at 250, which means I need to embed another if function at this point. So I'm going to embed another one, if brackets. I'm going to say if this number is greater than 250,000, which is basically our exemption amount, then we want you to take the 250,000, it's our cap amount. If not, comma, then we'd like you to take this number. And then we'll close up the brackets, close it up again, and let's see if that does what we would expect it to do. So it's going to put a 0 here. That makes sense. If I copy it down to this one, notice it did what I wanted to do, but I could make this one negative. The exclusion, maybe I should make the exclusion negative. So maybe I want to change that to make it negative. I'm going to delete this and say, let's do it again. So if this number is less than 0, then take 0. If it's greater, then I have an if. I want you to take the negative of this number. So I'll flip the sign on it. So I'll say negative of that number. Now let's try it. So it's 0. And then that one flips to negative. And once I get over 250, it should cap at 250. So if I take this all the way down, then it caps at that 250. Once again, notice I took 250, a positive 250. So maybe I want to make that 250 a negative, which I do. If I want to make this whole thing negative, one more adjustment. So if it's greater than 250, then we want you to implement not 250, but negative 250, and then enter. And now let's copy it on down. So now if I go down here, it goes over 250, it caps it at 250. So that's what we're going to assume our exemption is. If there's a gain, if there's a loss, we don't have a tax implication. And the exclusion doesn't apply. If there's a gain, we got an exclusion up to 250, so we want this to match up to 250, and then if it's over 250, then the exclusion is only going to give us 250, assuming we're not married in this case. And again, the tax laws can change over time, but that's the general idea. So then we're going to get the taxable gain. So the taxable gain amount, then I'm going to format paint this will be the difference between the two. Now this one gets a little weird again because I got this 0 here. So what I could do is another if function. If I subtract these two out and it becomes a negative number, then I want it to be 0. And if it's a positive number, I want to take the positive number. So I'm going to do that again. We're going to say equals if brackets. I'm going to take the sum of these two numbers. So if the sum, let's say sum brackets of these two numbers, closing the brackets, is greater than, or let's say is less than 0, then, which is a comma, we want you to just put a 0 there. 0. If not, comma, meaning it's greater than 0, then we want you to take the sum of these two numbers. And closing up the brackets and close up the brackets again. And let's see if it does what we expect. Obviously, these two summed up are going to be zeros. And then down here, it's still 0 because now it's summing up these two numbers, which sum up to 0. And then once we get below the exemption amount down here, it should then show us the taxable portion. So there's the taxable amount. So then finally we can apply the tax. So we're going to say the tax is going to be the capital gains tax, which could be at a different rate. So which I don't think we have in our table. Let's go on over to our table here. There's usually going to be a capital gain tax. We'll have a kind of a progressive structure as well, generally as well, but it'll be lower or less progressive than the ordinary income. So if we're at a 25% on the ordinary income marginal rate, the capital gain will typically be lower than that, somewhere between 10 and 20%. So I'm going to put it at 15% here. Let's add a row and put it at 15% for the capital gains to have a different rate. Again, you got to basically be careful in terms of how much that capital gains will be because it will be dependent on, in essence, your income level. But let's take a look at it. Let's insert and shift cells down. Obviously, if you qualify for the exemption, then you'll have the exemption and it'll be easier to calculate. But if you have some portion of the home sale that's subject to the capital gain, then you got to take that into consideration. And the best way to really get an idea of those is to do projections on the home sale using Essence software and whatnot, and then try to figure out what you think are going to be changes in the tax law. So now that we have that, we can go all the way back to the right and say, okay, well, the taxable amount, which we don't have until we get over the exemption down here, but let's calculate it up top. It's going to be equal to the taxable gain, which is going to be this, times the tax rate, which now I'm going to use that 15% for the tax calculation all the way to the left at the 15%, F4 on the keyboard, $ before the B and the 10, and then enter. Copying that down, so we'll copy that all the way down. So double clicking on it, and there we have it. So now we got the tax cash outflow which would come into play all the way down here once the property gain is at like year 19 above the exemption of the 250, which again, that's a significant exemption. If you're married, 500, so you'd have to have a significant gain to clear that. So then we can think, okay, the cash flow on sale. So what did I call that? The cash flow sale after taxes. Let's take I think I have a name over here. Cash flow sale before taxes. We're going to call this the cash flow for sales after taxes, AT. And then we'll just subtract the two out, 1, 0, 1, 2 on the years. Selecting those items, copying that down, centering it. And then we're going to say the cash flows after taxes is going to be, let's say this will be equal to the before taxes amount, the 97.5 minus, if there are any taxes, which there won't be until year 19, the tax flow, the outflow, copying that down. So there we have it. Let's widen this out a bit. So there we have our tax flow after the taxes. Let's spread this across between the two cells. Right click on it. I'm going to say format, and let's say horizontal and center across, and say OK, making this black and white. So there we have that. Now, next time we'll look at the net or difference between the cash flows between renting and purchasing, and we can then use that to basically do our calculation of the investment, do our IRR type of calculation. We'll do it on kind of a year-by-year basis, constructing a fairly complex type of table to look at it. But once we get it down, hopefully it'll make sense once we pull that information down. The thing that's complex about it is we'll assume kind of what would happen if we sold after each one of the years and try to build that into basically one table.